just as we go, we've got two meetings, and we'll go straight from one to the other without a break when we go live.
We're now live.
We're now live. Okay, right. Well, good afternoon, members of the committee, officers, and any members of the public who are listening in. This is a meeting of the Audit Committee, and I have from the chair, I'm Councillor Peter Adams, I have a notice to read before we start. Good morning or good afternoon and welcome to this meeting of the Audit Committee. I am Councillor Peter Adams, Chairman of the committee. I'm obliged to inform you that this meeting is being streamed live and recorded. Members of the public will be able to hear the audio of the meeting and view the papers shown on the screen. This meeting is being held using remote technology, and should any committee member experience technical difficulties during the meeting, they should immediately contact the designated IT officer on the number they have already been supplied with. Everyone is requested to mute their microphones unless asked to speak. Please only use the chat function to indicate the desire to speak. Do not use it for anything else, so that it's clear to those asking to speak, and the debate has to be heard by those listening on the auto feed. As chair, I will interpret the council's existing standing orders in light of the requirements of remote participation, with advice from the monitoring officer prior to making a ruling. At the start of the meeting, I will ask members of the committee to confirm their presence and any disclosable pecuniary interests they have in any of the items on the agenda. I will ask everyone that speaks during the meeting, including members of the committee and officers, to introduce themselves each time they speak. This is so that those listening know who is speaking. So we'll go to the roll call and disclosure of pecuniary interests. Members are reminded to disclose any pecuniary interest in any matters to be discussed which is not included in the register of interests, and leave the meeting prior to the matter being discussed. So I will now read out each member's name and ask them to confirm presence and any interests. Brian Williams.
I'm present and I have no pecuniary interest.
Michael Wood.
Present, Chairman, and no interest to declare.
Chris Mellings.
Present, Chairman, no interest to declare.
Johan Jones.
Must be muted.
Johan, you may be muted.
Present, no interest to declare.
Thank you. I shall now return to the items on the agenda, and the first item is apologies for absence.
Confirm that there are no apologies, Chair.
Thank you. Public question time. Any public questions?
No public questions, Chair.
Okay. And members' question time.
Again, no members' questions, Chair.
Thank you. Right, we'll go in a second. We'll go to the main item on the agenda, the second line assurance Treasury Strategy. Just before we start, my chat column is not working, so if you need to speak, can you actually wave so I can see you? Normally you just put I want to speak, but my chat thing seems to be logged into a meeting I've never heard of. So, but with that in mind, can we go to item 5 on the agenda, Treasury Strategy, and responsible officer reporting will be James Walton.
Thank you, Chair. I'm going to hand over to James Walton, Interim Executive Director of Resources speaking. I'm going to hand over to Justin Bridges in a second, as we have this item, a single item effectively on the agenda today. I thought it would be really useful for Justin to come along and just take you through the report in summary. Just to clarify, the Treasury Strategy has been approved by cabinet and is on its way to council on the 25th. And so to fit that sequence of events in, that's why we need to consider at Audit Committee today the Treasury Strategy. So I'll hand over to Justin and he'll quickly take you through the main points of the report, and then we're here to take any questions at the end. So if you're happy, Chair, over to you, Justin.
Thank you. Justin.
Thank you, Chair. Thank you, James. Justin Bridges, Head of Treasury and Pensions. So I'll just give you a brief overview of the Treasury Strategy. The Audit Committee should be very familiar with it. It's produced every year before final approval at full council. The Audit Committee also receive an annual Treasury report in September time, and there'll be an updated mid-year Treasury Strategy in December. So the figures are subject to change throughout the year. So there's a number of Treasury and potential indicators within the report that will be updated in December as part of the mid-year Treasury Strategy. And obviously economic data and interest rate forecasts will also be updated throughout the year. So the key points really to note within the report today, the council's borrowing requirement, that's largely driven by the approved capital programme, identifies a borrowing requirement of 118.9 million over the next 3 financial years. In addition to this, there is also potential borrowing requirement for future prioritised capital schemes within the capital strategy amounting to 113.6 million, but this is subject to further approval. The capital strategy is a separate report to the Treasury Management Strategy, and this is being reported to Council separately on the 25th of February. Paragraph 6.5 of the report gives a definition of Treasury Management, just to remind Audit Committee members. The Council's current investment portfolio as at the 31st of December, which is the reporting period, was 170 million, and that continues to be invested with highly credit rated financial institutions. And the main priorities continue to be the security of those sums invested, the liquidity of the investments, those cash is available when required, followed by return on those investments. Since the end of December, the investment portfolio is now above £200 million due to additional government grants being received due to the COVID business grants. So the current portfolio value is over 200 million. In paragraph 11 of the report, there's a table there that highlights the prospects for interest rates. It's quite an important table there. So as you can see, the Bank of England's Monetary Policy Committee, which sets interest rates each month, cut the bank rate, which is referred to in the table there, from 0.75% back in March 2020, twice down to 0.1%, which is the current rate. And that was as a direct consequence of the global pandemic and its impact on financial markets. The table also highlights there that that rate is not expected to change for the next 2 financial years. So that's going to remain at 0.1%. So that means investment returns going forward for this financial year and the next financial year are going to be at historically low levels. Interest rates currently, just to give you a flavour of, if you were lending to the UK government currently, for any period up to 6 months, they're actually paying negative interest rates. So the Monetary Policy Committee have talked about reducing interest rates to negative, but that's not the case at the moment. It's slightly above that at the moment at 0.1%. But this gives you a flavour that how low investment returns are, and they're going to continue to be this way for the next 3 financial years. That table also shows you the borrowing rates for various different periods, short-term borrowing rates and long-term borrowing rates. So you can see that they are expected to rise gradually over the next 2 financial years. In November, also last year, just an important note on the borrowing, the government had a consultation in the summer regarding changes to local authority borrowing rates going forward. And the results of that consultation were that the government reduced all borrowing rates by 1% in November. So those rates that you can see in that chart on that table in November 2020 were all reduced. They were a lot higher than that. But as you can see, the borrowing rates are still a lot higher than the investment rates. Another couple of points to note, the council's previously approved to lend £20 million to Connectus Housing Limited and Sevenside Housing, and to date they've drawn down 19.77 million of that. They've also agreed back in February 2019 that the council approved to lend 49 million to their wholly owned housing company Cornovi. That's included in the report. There's two loan agreements that were approved, one for 14 million and one for 35 million, and that's expected to be drawn down over the next 8 financial years. There's a table, it's paragraph 6.13 in the report, that this highlights the various Treasury management reports and the frequency they get presented to directors, cabinet, audit committee and council throughout the year. So you should all be familiar with that. It's a requirement currently under the SIPFA Treasury Management Code and the Prudential Code to set a number of Treasury and Prudential indicators for the next 3 financial years. So you'll see in the main body report, there's a number of Prudential and Treasury indicators with a description what each indicator relates to, and all those indicators are also summarised in Appendix 1 for information. The Appendix 2 within the report, that states the council's current annual investment strategy, which needs to be approved by council each year, and that details the creditworthiness policy, how often credit ratings are monitored, the authorised institutions which the council is authorised to lend to, and the limits in place for the internal treasury team. It also reaffirms that the security of capital is the key priority, followed by liquidity and then return on the investment. It also details any external service providers we use. So currently we use Link Asset Services as our treasury management advisor. And it also details in there the scheme of delegation for improving all treasury management reports and the role of the Section 151 officer. And each year the Section 151 officer has to have approval by full council in accordance with the Treasury Strategy. Appendix 3, the final appendix, details the council's minimum revenue provision policy, and again that's required to be approved each year, and that's just the accounting policy to set aside a minimum revenue provision to repay external debt. There's a number of recommendations in the report, 2.2, 2.3 for it's already been to cabinet as James said on Monday. The 2.2 is for audit committee are just asked to endorse the report with any comments, and 2.3 are all the recommendations for full council. So I'm happy to leave it there and take any questions that members may have.
Thank you. Members, have you any questions?
Yes, Chair Brian here, Brian Williams here. Can we take the script off the screen so that we can all see each other?
Brian, if you click on a picture of somebody at the bottom, then it will just automatically switch.
All right, it does. Bravo, thank you very much.
Okay. And
to
just sorry, Chair, Chris Mannings was waving as well. He did have a question he wanted to ask as well.
Right. To my mind, I'm comforted by the fact in the table 9.4, which is all Prudential Indicator 2, which is also repeated in the appendices, that the capital financing requirement is well above our gross borrowing for the next 3 years. We're that which we need, the financial requirement, is not going to have to be over borrowed to achieve it. Indeed, I don't think we can. So that table gives me reassurance, particularly. And the one question I have actually doesn't relate to any of the tables, but it relates to page 29, which is well on in the report. And there's a paragraph headed Temporary Investment Strategy. which talks about if an external fund manager is appointed in 21-22, which is the year we're coming up to, etc., they would have to adhere, and it goes on. Are we contemplating actually appointing an external fund manager? We haven't, to my mind, had an external fund manager before, and I wondered what the point about this particular paragraph is.
Yeah, I can answer that one, Brian. Justin Bridges, Head of Treasury and Pensions. We have historically had an external fund manager, but you're talking probably 10 years ago now, over 10 years ago. But the internal Treasury team outperformed that external manager. So obviously the fees incurred by appointing external managers is far outweighs the additional performance. So a decision was taken a long time ago that all the internal investments will be managed by the internal Treasury team. But there is it's in the report, just in case in the future we do appoint another external fund manager, but we haven't for a long period of time. And this stating that they'd have to adhere to all these Treasury and potential limits if we did appoint one. So I think there's a limit of £30 million if we did appoint an external fund manager to manage any of the council's internal investments.
But the short answer is that you're not intending to appoint one. You're not intending to ask the committee to approve one. Okay.
Okay, thank you. Chris? Councillor Melling?
Thank you, Chairman. Chris Mellings, member of the committee. Three issues. Firstly, I think it's fair to say that we're moving into different territory. I think last year, now this year, in that we're looking at sizable capital programs. So for the first time in a long time, there's going to be elements of or significant borrowing in a way that we haven't experienced in recent years for reasons that have been sort of fleshed out elsewhere. Justin referred to the issue that's about if we invested with the government at the moment, there's negative interest rates in application. Page 15 of the pack, the table that again he referred to, talks about Link's forecast as at December. Now, appreciate that's not that long ago, but obviously last week the Monetary Policy Committee gave an indication that it has been in touch with the banks, asking them to prepare within 6 months for negative interest rates. Now, I know that there's, depending on who you talk to, whether that people think that's going to happen or not. Clearly, the fact that the Bank of England are looking to put this into their toolbox of measures and responses might indicate that we're heading in that direction. So I just wonder at this stage, if that were to happen, what the implications may be for us as an authority and on the strategy, although I appreciate that obviously this gets reviewed during the year. So if there were any changes to the wider environment, then I guess that would be updated as a consequence of that. The final issue, obviously our Treasury strategy is around relatively short-term investments, etc., and it's based on security and secondly liquidity. On page 29, at the top of the page, it makes a reference about restricting the total investment portfolio to £70 million, excluding the shopping centre acquisition. And I just wonder what the significance of excluding that from the figure that's quoted there. I didn't understand that, if I'm honest. Then linking it back to the liquidity issue on page 42, where it sets out the non-specified investments, it refers to the JPUT, and the table there gives an A and a B, why use it, and B associated risks. For the JPUT, it doesn't it doesn't break it down into an A and a B, and I just wonder if what the rationale for that is. What's the background to that? And then it talks about the maximum maturity of investments, and it says 5 years. Well, I wouldn't have thought that property, irrespective of whether it's a shopping centre or not, would be considered liquid. If we needed to raise money quickly and we wanted to divest ourselves of it, I'm not sure whether it would happen very quickly. So I just wonder why that's included and what the relationship is with the liquidity issue. Those are the comments I wanted to make anyway, Chairman. Thanks very much.
Sorry, Jason, do you want to answer?
Yeah, sure. Thank you, Chair. Justin Bridges, Head of Treasury and Pensions. So there's quite a number of points you've raised there, Chris. There is 2 separate limits talking about the shopping centre. There is 2 separate limits. The 70 million is for the internal Treasury team, and that relates to, I mentioned earlier about the loans, the 49 million pounds worth of loans to Canovi, the 20 million pound to the housing associations, that's included in that, and the internal Treasury team. So if they wanted to invest for a period greater than 364 days, that's why that limit's set. There is a separate limit set specifically for the shopping centre when it was acquired, and the additional capital expenditure they're forecast to spend on that over the next 2 years. And obviously the bits about the JPUT and all that, that's a completely separate report. So that'll all be covered in there was a separate report around about the shopping centres. It's just listed within the Treasury Strategy as we need to, at the moment it's being treated as an investment, and we need to set a limit on that. The details surrounding the JPUT would be a separate report that's gone to council. There's a number of issues you raise about the interest rates going forward, turning negative. I don't think interest rates, I think the last MPC meeting, they confirmed that they don't want to go down that route to reduce interest rates in the UK to negative rates. They much prefer quantitative easing, obviously to get the economy going again. So, but as you say, there's a large borrowing requirement in the capital programme this time, but because of the differential in rates, borrowing rates, investment rates, we would probably run down internal cash balances. So I mentioned earlier that we've got over £200 million of investment balances. So instead of externally borrowing from the Public Works Loan Board or somebody else in the market, because of the differential in rates, so in that table, so if you're borrowing for 25 years, say, that rate, you'd be paying, the government would be 1.5% currently, and obviously you're earning less than 0.1% on that. So we'd probably run down investment balances rather than externally borrow. But obviously interest rates could change in the future. They're not forecast to change over the next couple of years. But everything that's going on at the moment with the global pandemic, the vaccinations, things do change. That's the position at this point in time. That's Link's forecast, as you say. It's December. Obviously, we've had Brexit since then. It's all been agreed. We've had further MPC meetings since that forecast, but I think it states in the report that those rates haven't changed since then. So that's why that table's remained the same. So I think that's covered the majority of your points you raised there, Chris.
Chair, if I may come in as well, just to build on that slightly. So James Walton, Executive Director of Resources. Just to really flesh that out a little bit more in terms of what Justin's saying there, the thing you need to remember about the Treasury Strategy is it is an enabling paper. It's a policy. It's setting out the framework. It doesn't necessarily follow, it absolutely doesn't follow that then what's listed within that is actually what's going to happen. So we see a capital strategy, we see a capital programme being developed. The Treasury Strategy needs to take into account the implications of that given a certain set of circumstances. So that means everything within that capital programme is delivered, and we don't have the cash balances, and we don't have alternative sources of funding coming through, etc., etc. In all those scenarios, then the question we have to ask ourselves from the Treasury Strategy is, would it be affordable, therefore, to take it forward? So we undertake the potential indicators calculations to see what that looks like, and that gives us the Treasury Strategy. So that gives the authority comfort that if we go down a particular set of circumstances, a particular route, that the Treasury Strategy is set up to do that behind it. The actual decisions, though, so I think you opened up by saying there's a significant amount of borrowing going to be undertaken next year. The answer is there is the potential to happen, but the decisions around that borrowing actually will flow from the decisions made by council in terms of what goes into its capital strategy and particularly into its capital programme. And then this allows us, Justin, in the background to manage the Treasury on the back of that. So I hope that just gives a little bit fuller explanation. Thank you.
Okay, thank you, James. Right, I've just got one for you, Justin. On page 11, prudential indicator number 4. Okay, the bottom line, commercial activities stroke non-financial investments, shows 3 years, looks like expenditure, 46 million, 39 million, and then nothing. Can you explain what those figures mean and why we go from 39 million to nothing in a year?
Yes, Chair. Justin Bridges, Head of Treasury and Pensions. That is commercial borrowing that's anticipated over the next 2 financial years, which has been approved as part of the capital programme. There is nothing currently approved within 2023-24 for commercial activities, but obviously this gets refreshed, this strategy each year. So potentially in the future there could be something, but at this point in time we've only got 46 million in 21-22 and 39 million expected borrowing for commercial purposes, and there is nothing expected in 23-24.
Thank you.
Chairman, I'm having heard the various explanations of our Treasury team. I'm happy to move that we endorse the report.
Okay, do I have a seconder for that?
I'll second that, Chairman. Councillor Michael Wood.
Okay, is everyone in agreement with that? Yes.
Aye.
No one against, no one abstaining? No. Okay, in that case, that is passed. Okay, thank you. And I think our last item 6 is the date of the next time of the next meeting, which is the 4th of March at 1:30 p.m. So that will be the next meeting of the Audit Committee. So thank you for that, and we'll go straight on to the audit training now.